Good evening, everyone, and welcome to today's Market Close Report. If there is one word to describe today's global market, it is risk aversion. And the epicenter of this storm was undoubtedly China's A-share market. Let's start with the eye of the storm. The A-share market opened under heavy pressure this morning after the details of the weekend's U.S. tariff and investment restriction policies were released. The selling was panicked and relentless. The Chi-Next index, which tracks high-growth stocks, suffered a devastating drop of 7.14%, making it the worst-performing major asset class globally today. This was not just an isolated event in China. It triggered a wave of risk aversion that swept across global markets. The selling was concentrated in technology and growth stocks, particularly in semiconductors, artificial intelligence, and new energy sectors. Now, let's turn to the U.S. market. On the surface, the three major indices closed nearly flat. But this calm masks a deep internal divergence. Tech giants like Nvidia and Tesla are still under significant pressure. Nvidia has fallen 4.56% over the past 7 days. The trend of tech stocks weakening has not changed. On the other hand, cryptocurrency-related stocks bucked the trend and moved higher. Bitcoin rose 1.28% today. IBIT and MicroStrategy also saw gains. The market is showing extreme divergence between risk aversion and a small group of so-called brave investors chasing alternative assets. In Europe, the semiconductor sector likely came under pressure as well, hit by the double blow of the A-share crash and the Netherlands' expansion of export restrictions on chip-making equipment to China, which takes effect on September 1st. So, where did the money actually go? The answer is very clear. In the bond market, the 10-year U.S. Treasury yield fell for the week to 4.541%, meaning bond prices went up. This confirms that money is flowing into safe haven assets. In commodities, WTI crude oil rose slightly today, up 0.88%, driven by expectations of extreme global heatwaves and tight energy supply. Gold, while down 1.8% for the week, is still trading at a very high absolute price, indicating that some investors are still seeking shelter. So, the final destination of capital today was cash, U.S. Treasuries, crude oil, and defensive sectors like utilities. Technology stocks and the A-share market were the biggest victims of capital outflows. There is one structural signal we must pay close attention to. The stock AXTI has lost more than 50% of its value in the past month. The Shenzhen Component Index has fallen 8.9% in the last 7 days. These are not isolated stock moves. This is a structural signal that the market is systematically liquidating high-risk technology manufacturing assets. Looking ahead to tomorrow, the Chi-Next Index, after crashing 7%, is technically due for a potential bounce. But the key is whether U.S. stock futures can hold their current levels overnight. If U.S. futures fall further, the A-share market will open under even more pressure. If U.S. futures stabilize, we might see a weak rebound. Our base case for tomorrow is that the Chi-Next Index will trade in a range of 3,300 to 3,420 points, with a daily volatility of 3 to 5%. The bias is for a weak and choppy session. Meanwhile, the power and utilities sector, driven by the ongoing global heatwave, could outperform the broader market. Our final takeaway is this: the market's risk appetite is at an extremely low level. Until we see a clear signal that the panic in A-shares has exhausted itself and the VIX volatility index has turned lower, any attempt to buy the dip is high risk. For investors holding A-share tech stocks, using index futures or inverse ETFs to hedge is a prudent strategy. Our core conclusion is simple: cash is king, stay defensive, and patiently wait for the risk to clear.